Welcome back to the Deep Dive. Today we are jumping into a story that, well, it proves you can teach an old land developer some very new tricks.
And very big tricks at that.
Exactly. We're talking about Hughes Holdings, or HHH, a name you probably associate with sprawling, sunny, master-planned communities.
Right. Think Summerlin in Vegas or the Woodlands in Texas.
But HHH is no longer just selling acreage. They've just made a transformative, a half a company-sized acquisition. It's designed to pivot them from a real estate developer into a full-fledged diversified capital allocator.
It's a seismic shift, really. And the centerpiece of this whole transformation is HHH's definitive agreement to acquire the specialty insurer and reinsurer Vantage Group Holdings.
So what we're seeing is the execution of a strategy that's been building for a while now.
For years, really, using that real estate wealth to establish a powerful insurance-backed holding company. It's a classic playbook.
Okay, let's unpack this with the headline numbers first. Just how massive is this bite they're taking?
It is huge. So HHH is acquiring 100% of Vantage Group Holdings for approximately $2.1 billion.
$2.1 billion.
Yeah, and you have to put that into context for a moment. HHH's current market capitalization is only around $4.14 billion.
Wow. So they are essentially betting half their market value on this single insurance venture.
It signals absolute commitment. There's no turning back from this new direction.
That's aggressive. And for those of you tracking valuation, what does $2.1 billion mean in terms of a multiple for Vantage?
It's not cheap. The price translates to approximately 1.5 times Vantage's estimated year-end 2025 book value. So it's a premium valuation.
Which reflects Vantage's growth, I assume.
Exactly. It reflects their rapid growth and that specialized platform.
Wow.
The deal itself was announced on December 18th, 2025, and assuming all the regulatory ducks line up.
Which is a big assumption.
A very big one, especially with U.S. and Bermuda insurance clearances. But if all goes well, we expect this to formally close in the second quarter of 2026.
Okay, so a major shift in focus requires a regulatory nod that they're financially sound. How have the rating agencies reacted to this?
Well, AM Best, they're the key credit rating agency for the insurance world. They placed Vantage's ratings under review pretty much immediately following the announcement.
Okay, and Vantage's rating was good to begin with.
Very solid. An A, excellent financial strength rating. AM Best designated the review with developing implications. Now, while this is standard M&A procedure, it's a critical indicator. The market will be watching HHH very closely.
To make sure the new structure provides stability, not risk.
Precisely. To ensure the new holding company structure provides long-term capital stability rather than undermining Vantage's balance sheet.
It's so easy to forget who HHH actually is when we start talking about financial ratings and insurance floats.
Right.
We need to ground this transformation in the real estate roots to really understand the magnitude of this pivot. For decades, HHH meant one thing. Land.
Land, exactly. They are synonymous with these high-value, carefully planned communities like Summerlin, the Woodlands, Bridgeland. Their valuation has historically been tied to the value of their undeveloped land and, the pace of home sales.
So this transaction just completely redefines the company's identity.
It does. They are consciously shifting away from being a pure-play real estate company whose earnings depend so heavily on cyclical housing markets.
And the architect of this shift is, of course, Executive Chairman Bill Ackman. He's not exactly shy about his ambitions.
No, he is not. Ackman has been the primary champion of this strategy, and he's been explicit in citing the success of Warren Buffett's Berkshire Hathaway.
The Berkshire blueprint.
It is. The blueprint is clear. Leverage, stable, predictable capital, what we call the insurance, float to fund, high conviction, long-term investments outside of the core real estate business. That vision is the philosophical foundation for this entire deal.
And that foundation was built with a lot of capital well before this acquisition was announced. Let's talk about that precursor event from May 2025.
Yes. The May 2025 transaction was the necessary capital injection. That's when Pershing Square Capital Management, PSCM, acquired 9 million newly issued shares for a massive $900 million.
And that pushed their stake up significantly.
Oh, yeah. It immediately increased Pershing Square's collective ownership in HHH to 46.9%. Crucially, this gave HHH the clean capital it needed to move beyond real estate.
To acquire controlling stakes in other companies.
Exactly. Specifically insurance companies. That was the explicit action that turned HHH into a platform that was actually ready for this kind of diversification.
So the platform was built, the capital was raised, and Vantage is the first major asset plugged into the system. Tell us more about the target. Vantage is not some old school insurer, right?
Not at all. Very young, actually. Established in late 2020 and backed by major private equity firms, Carlyle and Hellman and Friedman. They scaled incredibly fast.
Into what exactly?
Into a sophisticated specialty insurer and reinsurer, focusing on a globally diversified portfolio of property and casualty, or P&C products. It's a modern, tech-forward platform, which is really important for efficiency.
So what makes Vantage specifically the ideal partner for this Ackman blueprint? They made a strategic choice in 2023 that seems highly relevant here.
It's absolutely key to why HHH sees them as such a clean, attractive asset. In 2023, Vantage deliberately reduced its exposure to property catastrophe excess of loss premium.
Okay, hold on. What does that technical term mean for the average investor listening?
Right, so think of property catastrophe excess of loss as the most volatile, unpredictable risk on an insurer's books. It's the exposure to major hurricanes, earthquakes, massive wildfires.
The really big, scary stuff.
Really big, scary, and potentially bankrupting stuff. By shedding that risk, Vantage intentionally reduced the volatility in their underwriting results. They made themselves a much cleaner, more predictable engine for HHH to plug into.
They want stable float, not a massive catastrophe gamble.
Exactly. Vantage cleaned up its portfolio specifically to enhance capital adequacy, and in doing so, positioned itself perfectly for this very acquisition.
That makes perfect sense. They want a steady stream of premium income to invest, not a roller coaster of weather events. Now, let's dive into the core of the deal, the money. A $2.1 billion all-cash deal when your market cap is only double that. It demands some creativity.
And the structure is, well, it's a masterclass in leveraging deep shareholder alignment. HHH is covering $1.2 billion of the price tag using its existing cash reserves.
From all those real estate sales.
Right, but the remaining $1 billion is the crucial piece. It's coming via the issuance of a bespoke financial instrument to Pershing Square Holdings, or PSH.
The PSH preferred stock. This is where it gets really complex. And for any listener who owns common shares, this structure is what determines their future value. Let's break down those mechanics.
Okay, so the instrument is called the non-voting exchangeable perpetual preferred stock.
A mouthful.
It is. So it's non-voting, meaning PSH doesn't get control. It's perpetual, meaning no fixed maturity date unless HHH acts. And it's issued in 14 equally sized tranches.
And HHH has a 7-year call option period to repurchase it.
Correct. The stated goal is crystal clear. HHH wants 100% economic ownership of Vantage within those 7 years.
So HHH has 7 years to buy back PSH's stake. What determines the redemption price? Because that price is what ultimately defines success for both parties here.
It's structured as a greater of scenario. It's designed to be PSH's safety net and HHH's success metric. The price HHH pays is the greater of two figures.
Okay, what's option 1?
Option 1 is the safety net, the original issue price plus a guaranteed 4% annual step-up. You could think of this as PSH's minimum guaranteed rental fee for loaning HH the capital.
Regardless of how the insurance business does.
Exactly. Wildly successful or just mediocre, they get their 4%.
And option 2 is the success metric.
Correct. Option 2 is 1.5 times Vantage's book value, multiplied by the ownership percentage of the tranche being called. So if HHH, under new investment management, drives Vantage's book value way up, they'll be forced to pay PSH based on this higher valuation.
Which is expensive for HHH, but it means things are going really, really well.
It signals massive underlying value creation that then accrues to the common shareholders after those preferred shares are gone. It's an incentive alignment mechanism that truly rewards success.
I wonder what happens if HHH just stalls or decides not to redeem the shares after those 7 years expire. Does PSH just have to sit there?
Absolutely not. If HHH doesn't repurchase the stock after 7 years, PSH gains an exchange right. They can exchange the preferred into Vantage common stock.
But there's a cap on that.
Right. It's capped at 49% ownership without independent director approval. They also gain the right to force a public listing of Vantage, so it puts a lot of pressure on HHH to execute that redemption plan.
And the final stick in this carrot and stick arrangement, the penalty for missing a repurchase date.
And that's where the structure gets genuinely punitive. If HHH fails to complete a required repurchase, those unpurchased shares immediately start accruing a very high 10% per annum dividend.
Ouch.
It's a severe penalty designed to ensure HHH is laser-focused on acquiring 100% economic ownership. and doing it promptly.
Let's talk operations, because the financing only works if the insurance company is profitable. And profits in insurance aren't just from underwriting, they're from investing the float. This is the ultimate connection to the Berkshire blueprint.
And the operational alignment here is striking because it tackles the typical drag on profits, investment management fees. Pershing Square Capital Management, PSCM, is expected to manage Vantage's general account and all other investment portfolios on a fee-free basis.
Fee-free. How much of a game changer is that? What do typical insurance platforms pay?
An average specialty insurer might pay 50 to 100 basis points, so 0.5% to a full percent on assets under management.
And on billions of dollars in float, that adds up.
It does. Eliminating those fees translates to tens of millions of dollars annually flowing directly back to HHH. It significantly enhances the platform's return on equity potential right out of the gate. That's huge accretion for HHH common shareholders.
And we should expect the investment strategy itself to shift under PSCM's guidance.
Yes. The strategy will pivot away from the typical conservative, bond-heavy insurance investing toward higher allocations in public equities, consistent with the philosophy Ackman uses for Pershing Square.
But balanced with some safety.
Oh, for sure. This will be balanced by a strong allocation to cash and short-term treasuries. The combined effect, fee-free management, and a higher allocation to potentially higher returning assets is expected to just turbocharge investment returns.
What about Vantage's leadership? Is the goal to shake things up internally?
Quite the opposite, actually. Vantage is expected to operate broadly consistently post-transaction. They retain their name, their brand, their culture, and critically, their highly respected CEO, Greg Hendrick.
So the core business stays the course.
It does. The investment engine just gets a major fee-free upgrade.
This truly is a high-stakes, leveraged bet on replicating that holding company model. Which brings us to our outrageous but plausible trade idea. And remember, of course, this is purely for entertainment and is not financial advice.
Okay, so the trade here is a conviction long position on HHH common equity. It's based on the assumption that Bill Ackman is correct, that the Berkshire Hathaway model can be cloned, and that the fee-free float just accelerates the whole process.
Walk us through why the preferred stock mechanics are the engine of this trade idea.
It comes down entirely to leverage and alignment. That 4% step-up floor for PSH minimizes the cost of capital risk for HHH in the near term. They have stable funding. But the common shareholder upside is massive if the plan works.
So you're betting that HH aggressively uses that 7-year call option to redeem the preferred stock at the higher 1.5 times book value multiple.
Exactly, because redeeming at that high multiple can only mean one thing.
That the new investment strategy has caused Vantage's book value to soar.
Right. The common shares win big because the preferred stock's economic ownership is capped. Once it's redeemed, any value created by that fee-free investment prowess beyond the redemption price accrues directly to the common equity. It's a leveraged bet on a successful transformation.
That makes the preferred stock mechanics the ultimate litmus test for the success of this whole corporate reinvention. If they're redeeming those preferred shares quickly and at the higher valuation, it's a clear signal the insurance float is compounding value way faster than anyone expected.
It's a very powerful incentive structure.
So the essential takeaway here is that HHH is undergoing a fundamental transformation, funded by this uniquely structured preferred equity deal with its largest shareholder, Pershing Square.
And this deal positions HHH to merge its valuable, stable real estate assets with a potentially high-growth, fee-free insurance float engine.
We'll all need to be watching for that Q2 2026 closing date for the regulatory approvals.
And beyond the closing, that complex PSH preferred structure, that 4% floor versus the 1.5 times book value hurdle, that becomes the metric to follow. That tells you where the value is being created over the next 7 years.
And that brings us to our final thought for you to chew on. Given that this complex preferred stock structure gives PSH a protected floor and massive upside, while simultaneously guaranteeing HHH a fee-free capital management structure, does this tight alignment of interest truly mirror the simple, clear alignment seen in established conglomerates like Berkshire?
Or does the mandatory exchange and buyback structure introduce unique governance risks that common shareholders need to uniquely monitor moving forward?
A question of structure versus trust. Food for thought indeed.
It certainly is.
Thanks for joining us for this deep dive. We'll catch you next time.